Your tax return is not just something you send to the IRS and forget about. It's one of the first things lenders look at when you apply for business funding. And whether you realize it or not, what's on that tax return can make your loan easy to approve or almost impossible. A lot of business owners don't understand this. They think, I'll just write off everything so I pay less in taxes. And then they're shocked when a bank says they don't qualify for financing. So today we're talking about how your tax return affects your ability to get approved, the difference between write-offs and bankability, and the biggest red flags lenders see when reviewing your numbers. Let's start with the truth. Lenders don't care how busy you are. They care how profitable you look on paper. When a bank or lender reviews your application, they're trying to answer one main question. Can this business comfortably repay this loan? They use your tax returns, financial statements, and bank statements to judge that. And your tax return is often the most trusted document because it's signed, filed, and legally certified. If your return shows very little profit, lenders assume you don't have much room to repay debt, no matter how busy you say you are. That's where business owners get stuck. They maximize deductions to lower taxes, then complain they don't qualify for loans. So let's talk about write-offs versus bankability. Write-offs are great for lowering your tax bill. No one likes paying more in taxes than they have to. But every write-off lowers your reported profit, and lower profit makes you look weaker to lenders. Bankability is how strong and reliable you look on paper to a lender. It's based on net income, cash flow, debt-to-income ratios, consistency, and growth trends. When you write everything off, your business might look like it's barely surviving, even if in real life, it's doing fine. So the key isn't write off everything or write off nothing. The key is strategy. Smart business owners plan with both taxes and funding in mind. They ask, will I need funding in the next 6 to 12 months? Do I want to buy equipment, expand, hire, even buy real estate? If the answer is yes, then your tax strategy needs to support that goal because you can't look broke on paper and expect a lender to trust you with money. Now, let's talk about red flags lenders see. The first big red flag is extremely low or negative net income. If your tax return shows losses year after year, lenders start asking questions. Is this business sustainable? Is the owner using the business as a tax shelter? Is there real profit even here? Even one bad year can hurt, but multiple low profit years make approvals much harder. Second red flag, big swings in income. If you made $500K one year and $120 the next, lenders want to know why. Was it a market issue? Did you lose a major client? Was it poor management? Volatility makes lenders nervous. They like consistency. Third red flag, too much personal spending through the business. If your tax return shows heavy meals, travel, vehicles, and other expenses with low profit, lenders assume the business is supporting your lifestyle instead of building strength. They worry that debt payments won't be prioritized. Fourth red flag, mismatched numbers. If your tax return says one thing, but your bank statements tell a totally different story, that's a problem. Lenders compare tax returns, financial statements, and bank deposits. If they don't line up, it raises trust issues. Fifth red flag, high debt with low income. If your return shows small profits but large existing loan payments, lenders question how you're surviving at all. And that doesn't mean you can't get funding, but it does limit your options. Now let's talk about what you should actually do. First, talk to your accountant about your future, not just your last year. Tell them, I want to grow, I may need funding, I care about bankability. Good accountants help you balance tax savings with financial strength. Second, understand your add backs. Some lenders add back certain expenses like depreciation, amortization, one-time expenses, and even sometimes the owner's salary. This can help, but don't always rely on it. Not every lender allows every add back, and banks are stricter than alternative lenders. Third, build a paper trail. Make sure your books are clean, deposits are consistent, expenses are categorized correctly, and owner contributions and loans are labeled properly. Sloppy books kill deals. Fourth, plan 6 to 12 months ahead. If you think you'll want funding, don't wait until you apply to fix your numbers. By then, it's too late. Your tax return is a snapshot of how you ran your business. You can't rewrite it after the fact. Your tax return is either helping you or holding you back. It can lower your taxes but kill your loan chances. Or it can cost you a little more in taxes, but open the doors to growth. The best business owners don't think short term. They think strategically. They don't ask, how do I pay the lease this year? They ask, how do I build a business that can grow next year? Because tax savings are nice, but access to capital can change your business forever. And if you're not sure where you stand, if your tax return is helping or hurting your loan chances, that's something you should find out before you need funding, not when you're already desperate. And that's where having the right partner matters. At ROK, we don't just look at one number, we look at your whole story, your cash flow, your goals, your timing, and your options. We help business owners understand what lenders see and how to position themselves better for approvals. So if you're thinking about funding this year, or even just trying to get bankable, start with your numbers. And if you want clarity, options, and real answers, ROK Financial is here to help. And if this helped you, hit like so more business owners can see it, subscribe for real-world business and funding content that actually matters. And if you're wondering whether your tax return is helping or hurting your chances, click the link in the description, connect with ROK, and find out where you really stand. This content is intended for general informational purposes only. Tax rules and deadlines can vary based on individual circumstances, so be sure to consult with your accountant or qualified tax professional before filing.